Happy Friday, everybody. I don't know, though, after the week that we've seen in the stock market, how many of you are feeling happy right now. But, the thing that I can assure you is that it's not as bad as you think it is. And if you need further proof of that, a great book to read would be one by Hans Gosling titled Not As Bad As You Think It Is. And if you want a free copy of that, hit me at shannonrobnett.com, contact us, say free book. And I will send you that free book. But it is a great read, and it talks about all different kinds of things, not the economy as we know it. But I want to talk to you a little bit, and I want to take you back to a place in time in 1921. And in 1921, there was a lot of crazy things happening. The stock market was booming. Everybody was happy. The World War I was all done, and things were going so well in the stock market that people were selling their furniture to buy stocks because it was literally doubling overnight, and everything was becoming worth more money. Real estate was becoming worth more. Cars were becoming worth more. Everything was booming, and it was in America, and it didn't end well. That was Germany in 1921, and the Deutschmark peaked at about $1 million Deutschmark to $1. That was inflation. That was a structural problem with the Deutschmark, not with the asset. I hear this all the time, and people come to me and they go, dude, my house is worth so much. In compared to what? And if we look at it, your house, your 3-bedroom, 2-bath, your pride and joy, 2-car garage, your huge backyard, hot tub on the patio, all of those things are still what they were when you bought it. Maybe you've done some home improvement, and that's great, and that did add value, but it hasn't been like all of a sudden you woke up, you went outside, you got a 4th-car garage, right? Whoa, now it has more value. But what we do is we get caught up in dollar-denominated thinking. We start thinking about how we pay for things in dollars and what those dollars will buy us. And the problem is we don't have a problem with your house or the gold that you bought or the hard assets that you have. And a definition of an asset is something that pays you. A liability is something you pay. So when you look at the assets are still of value. But what we do is we convert dollars to assets. And then when we go to sell the asset, we convert back to dollars. But if you go to longtermtrends.net, and I'll put that in the chat below so that you can go to shannonrobnett.com. You can also get this information. But if you go to longtermtrends.net, real estate gold ratio, /real estate gold ratio, it's really easy to see that from all time in 1890, you were buying a house for 304 ounces of gold. I don't know exactly what kind you were buying, but I think it was kind of standard. Okay. Fast forward to 1929, right before the stock market crash, you were trading 538 ounces of gold for a house. But in 1933, at the bottom of that crash, you were back to 234 ounces of gold for a house. Now, we can imagine that the house didn't have a garage but we were talking about a single family home, right? And this is research that was done by a couple of really smart dudes, Robert J. Schiller and Carl Case, right? But if you look at this and you fast forward to 1970, September 14th of 1970, it appears to peak that a house cost 990 ounces of gold. 990. That's the peak. Now, I'm looking at this chart. This chart shows like everything that you could possibly want here, right? And what it's showing is that it is let's see, share screen. Look at that. Look at me go. Go, dog, go. And it shows that that was the peak. That was the highest point in this chart. Oh, sorry, 1,008 ounces of gold is the peak. But it crashed in 1980. Remember 1980? It got down to 115 ounces of gold for a house. Went back up in 2001, 730. Went back at the bottom of the market and looks like about 2012 at 148 ounces of gold. We are currently sitting at 278 ounces of gold for a house in America. So why are we talking about record pricing? Because we are talking about massive loss of value in the dollar. And like social credit, when you have done the kind of things that our government has done, both sides of the aisle, this is not a political speech, but when you have done the things that have driven the dollar down, we just gave $40 billion, another $40 billion, I might add, to a country that's at war. Now, I'm not going to step into that political debate, but if we can't keep our prices down, where do we get that money to send to them? We printed it. So we inflated our money. What that means is that now it takes more of yours to buy what you need because we printed more and the assets behind the money is less. The reality is at the end of the day, the more we print, the more worthless it becomes, right? So as long as we're still printing money, as long as we're still sending money to all these other places, and as long as we're still providing all these free services that aren't really free, there's going to be this hidden tax called inflation. I don't know why they call it inflation when it really needs to be called devaluation, because we're trading an asset, we're thinking we're getting value, but we're not, and we can't figure it out. So at the end of the day, I'm going to challenge you guys to start looking at your assets compared to other assets, okay? So when you look at what your house is worth, look at what gold is worth. Look at what oil is worth. Look at those things in conjunction with each other and see how that value has or has not transferred over time and stayed relevant. Because the reality is, at the end of the day, if you're sitting here trading in dollar denominated thinking and you keep coming back to what would my house be worth, and we're really at record lows or near record lows for what your house is worth as of 2022, March 14th, 265 ounces of gold, right? And we had a dip in 2020, July 15th. That'd be about COVID central to 218, right? Bottomed out 209 in September, right? But the reality is, at the end of the day, you've got to start thinking, what is my asset going to trade for against another asset? And that is the only thing that matters. So when you do that, you're going to see a serious trend and change in what happens. So once again, if you guys are still doing the dollar denominated thinking, you're being ripped off. If you're leaving your money in dollars, you're being ripped off. When you're not seeing what an asset is and what an asset can do for you, it really means that you need to contact us over here at shannonrobnett.com. We can get you some information. Just shannonrobnett.com, contact us, free info on how to fight inflation. And we will get you information that will allow you to see how you can trade dollars for assets at near record pricing and still be able to receive inflated dollars back, right? So your cash flow is there, even though it takes more cash flow to go buy chicken or milk or fuel, right? All of those kinds of things have been changed on us. But I'm going to challenge you guys, take a look at what your assets are truly trading for and what they're really worth when it comes to the value of what they are in relation to other things. And so other assets. So when you look at that, yep, price of a Chevy went up, not because it's worth more than a Ford, but because those dollars are worth less than they used to be. So guys, don't get fooled. Don't stop thinking about inflation. As prices going up, start thinking about it as devaluation of the dollars that you're trading for it, and the fact that at some point we may get to the place where it'll take $1 million US to buy a Deutschmark or a loaf of bread. So not to scare you guys, but that's the world we live in, and that's the picture that I see on inflation. So real estate's still a great buy. You still have a lot of value there. Don't get fooled into thinking that that's changing. And we'll talk to you next time. You guys have a great week.